Ever placed a Forex trade at one price only to get filled at a completely different one? That's called slippage. And if you don't understand it, it can quietly eat into your profits. In this video, I'll explain what slippage is in Forex, why it happens, and most importantly, how you can avoid it as much as possible. Welcome back. If you're new to Forex trading, one thing you need to understand early is that the market doesn't always give you the exact price you want. You might click buy at one number, but the trade opens slightly higher or lower. That small difference is called slippage. And while it may seem tiny, over time it can make a big difference in your results, especially if you trade often, scalp, or use large lot sizes. Let's break it down in a simple way. Slippage is the difference between the price you expected to get and the price your order was actually executed at. For example, let's say EUR USD is trading at 1.1 thousand. You place a buy order expecting to enter at 1.1 thousand. But instead, your order gets filled at 1.1003. That 3 pip difference is slippage. Slippage can happen on buy orders, sell orders, stop losses, and even take profits in certain market conditions. Not always. There are actually 2 types of slippage. Negative slippage. This is when you get a worse price than expected. For example, you wanted to buy lower but got filled higher. Positive slippage. This is when you get a better price than expected. For example, you wanted to buy at 1.1 thousand but got filled at 1.0998. Most traders only complain when slippage hurts them, but technically, slippage can work both ways. Still, in fast-moving markets, negative slippage is usually what traders fear most. Slippage happens because Forex prices move extremely fast. Between the moment you click your order and the moment the broker executes it, the market may have already moved. Here are the main reasons why slippage happens. High volatility. When the market is moving fast, prices can jump in milliseconds. This happens a lot during major news events, interest rate decisions, or unexpected economic announcements. Low liquidity. If there aren't enough buyers and sellers at your chosen price, your order may be filled at the next available price. This is more common during off-market hours, holidays, or exotic currency pairs. News trading. Big news events can make spreads widen and prices move violently. Even if your setup looks good, execution can become messy. Large order size. If you place a very large trade, the market may not have enough liquidity at one exact price to fill the full order instantly. Slow execution. Some brokers have faster execution than others. A poor trading environment, slow platform response, or unstable internet can also increase your chances of slippage. Slippage is most common during major economic news releases, market open and close times, low liquidity sessions, flash crashes, or sharp volatility spikes. Trading exotic pairs with thin volume, using market orders in fast conditions. So if you're trading during high-impact events like NFP, CPI, or central bank announcements, slippage becomes much more likely. A lot of beginners underestimate slippage because they think a few pips don't matter. But here's the problem. If you're risking tight stop losses, scalping for small profits, or trading frequently, those small differences add up. Slippage can reduce your profit, increase your loss, distort your risk to reward ratio, trigger stop losses earlier than expected, make backtesting look better than live results. That's why understanding slippage is a big part of becoming a smarter trader. Now let's get to the important part. How do you reduce slippage? You may not remove it completely, but you can definitely lower your risk. Avoid trading during major news events. One of the easiest ways to reduce slippage is to stay out of the market when big announcements are about to drop. If volatility explodes, execution becomes less predictable. Unless you're experienced in news trading, it's usually better to wait for the market to calm down. Trade highly liquid pairs. Major pairs like EUR USD, GBP USD, and USD JPY usually have more liquidity than exotic pairs. Higher liquidity often means smoother execution and less slippage. Use limit orders when possible. A market order tells your broker, fill me now at the best available price. That gives speed, but it can also expose you to slippage. A limit order tells the broker, only fill me at this price or better. That gives you more control over entry, though the downside is your order may not get filled. Choose a reliable broker.